Hello everyone, I hope that you guys are doing great and I hope that your preparation up till now for your exam is also going well. As I've requested before within the previous lecture as well, that before you start the specific lecture, you have to ensure that all of the preparation of the syllabus area that we have already covered must be completed. Only after then you should move towards this lecture, because this lecture is going to be very important area for your syllabus. For the overall audit exam, this area has been tested again and again, and there is always 100% chance that the examiner will always ask questions from this area. And the name of today's lecture, the name of this topic is substantive procedures or audit procedures. This is one of the specific areas which is considered as one of the most difficult areas with an audit. If you are able to understand the basic concept behind substantive procedures, it is ensured that almost 10 to 15 marks will become easier for you within your exam. If you understand substantive procedures and if you understand the concept behind substantive procedures, then solving them within your exam is also very easy. But please note that every single thing that we cover up within this specific lecture is going to be very important for you guys, for your exam as well, and for your practical life as well. So please make sure that you understand every single thing that we are about to discuss. And if you have any kind of questions, please do not hesitate to ask me regarding this lecture. Please don't hesitate to ask me upon WhatsApp as well. Let's move towards the topic. The name of the topic is substantive procedure. If I take the name substantive procedure, what comes to your mind? Like, what is substantive procedure overall? If we talk about substantive procedures or overall procedures that we talk about, what is the meaning of the substantive procedures? In essence, the main definition of substantive procedure is test of detail. Now, all of the students who have understood the audit risk that was discussed in one of the previous lectures know that what test of details are. When you test a financial statement item within detail, obtain a breakup from the management, and test some kind of an evidence against it, that is known as a test of detail. So in essence, substantive procedures is also test of detail. But before we move towards the main lecture, let me give you an idea of substantive procedures from a practical life example. Let's suppose I asked you to go to the market and help me buy a phone, because you are a phone expert. I'm about to buy an iPhone and I don't know which iPhones are good, what could be the faults within the phones, and so on and so forth, whether the screen has been replaced, whether the battery has been replaced. I have no idea about it, and you are one of my close friends. I asked you to go with me to the market to please help me out to buy me this new phone, and this is the phone that we are talking about. If you are the expert that I'm hiring at the moment to go with me into the market, obviously I'll sit back, listen to what you have to say while you are testing out this phone. Now, what are the things that you would look at when you are giving me an advice whether I should buy this phone or not? The first thing you would look at is the screen itself. The second thing that you would look at is might be the camera itself. The third thing that you would look at would be the battery itself, the battery health within an iPhone. All of these things that you are looking at the moment, looking at from the phone, is substantive procedure itself. Whatever steps you take to verify whether the screen is real or not, whatever steps you take to verify whether the battery has been changed or not, whatever steps you take to verify whether the camera is working appropriately or not, these are known as substantive procedure. Now, a substantive procedure is a detailed explanation of every single step you took to verify something. Let's talk about the screen. To verify the screen, what can you do? Either you can push on the screen, and if there is any kind of change upon the screen, or if the screen reflects to or reacts to any kind of pressure that I'm putting upon the screen, this means that the screen might not be real. Another thing that you can do is that you can go to the settings app and it would show you an error message that the screen has been replaced, please, and it is not warranted at all. So there are multiple things that you can do, multiple angles that you can take to verify whether the screen is real or not. Every single angle from which you try to verify whether the screen is real or not is known as a substantive procedure. Now, it is not known as a substantive procedure unless and until you explain it in every single detail that you took to verify the screen. For example, I told you a procedure or a step that you can take is that you can open up the phone, go to the settings, and check whether there is an error message within the settings of any kind of screen replacement. That is one type of substantive procedure. It would help you verify whether the screen is real or not. So let me write it down first of all. So the first thing we did to verify the screen was to open the phone, and go to settings app and check whether there is a replacement warning for screen. And what would this help you verify? This will help you verify whether the screen has been changed or not. To verify whether the screen is real or not. So basically, when you write down a substantive procedure, you have to explain every single detail of what you did to verify something. Another example of a substantive procedure for the verification of the screen was you can put pressure upon the screen, and if there is any kind of distortion of colors, this would mean that the screen has been replaced. Now I can write it down here as well. A substantive procedure always contains what the goal was. The goal was to verify the screen itself. This was the goal. A substantive procedure always contains what the goal was, the number one thing. Number two, a substantive procedure always contains what you will do, what action will be taken. So the action will be, we'll go to the settings apps to check whether there is a replacement warning. This is the second thing, an action that has been taken by the auditor, by someone who is checking something out. And third thing that always will be present will be, where are you getting the evidence from? So we are getting the evidence from the setting app itself. This is the third thing, the evidence. Where is the evidence being obtained from? If I create a new procedure for this where I have to put pressure upon the screen, the evidence would be again the phone screen. If there is any kind of distortion, that is the evidence. What action am I taking? I'm putting pressure upon the screen. And what am I trying to verify? I'm trying to verify whether the screen is original or not. I can make hundreds of different procedures for the verification of battery. We can make hundreds of different procedures for the verification of the screen of this phone. We can make hundreds of different procedures to verify whether the camera is working properly or not. But the main thing is, this is the core of substantive procedure. There will always be a goal that you have to achieve. There will always be an action that you are taking. And number three, there will always be a place where you are taking or where you are getting your evidence from. Whether this is real or not, this evidence will be obtained from which area, that is always included within the substantive procedure as well. So a good substantive procedure always contains these three things. Now, before we move further ahead into the substantive procedures for a financial statement, what an auditor does when he is auditing financial statements, how he makes out substantive procedures, what you will do in your practical life as well, this is something that we will discuss after 20 or 30 minutes, because first we have to understand what are the key components of a substantive procedure. Again, the three key components are the same: goal, action, and evidence. First of all, let's come towards one of the main things within the world of audit, which is known as assertion. Now, assertion is something. What is meant by the word assertion? What is meant by the word assertion overall? What is the meaning of assertion? So before we move towards assertion, let's discuss in between ourselves. If you go to the management of a company, those who have prepared the financial statements, if you ask them the question that are these financial statements correct or not, what will they respond with? Automatically, every single time, whether there are issues in financial statements or not, we are not talking about that. We are talking about what will the management tell you. Management will always say there are no issues within the financial statements. The financial statements are correct. So let me write down the statement. The management will always say there are no issues in financial statements. They are correct. So correctness of the financial statements means that the management is asserting that the financial statements have been prepared correctly. There is no issue within the financial statement. Assertness means something that the management has thought of, imagined that we will have no issues within the financial statements. But this is not it. When we talk about the word assertion, it is very important for you guys, for your exam as well, to understand this properly. Assertion means that management, what statement did I use? I used a statement. Assertion means that management is trying to say that our financial statements which we have prepared are correct. There are no issues. This is just one line. Whenever management says that our financial statements are correct, they have no issues, this has multiple different meanings. The correctness of the financial statements, whenever, what did I say? Management, whenever they want to say that the financial statements are prepared correctly, this word, when management is saying that our financial statements are correct, although management is saying that our financial statements are correct, but what are they correct against? This correct word which is used here, which is used in the specific sentence, has multiple different meanings. And let's talk about the meanings now. Whenever management says that our financial statements are correct, they basically mean two things: that there is no EVCR issue and there is no COCA issue. Remember these acronyms for now. We will discuss them. At the moment, we will discuss them. But remember this: assertion means that the management is saying that our financial statements are correct. And whenever management is telling you that their financial statements are correct, this means multiple things. Basically, management is trying to tell the auditor that there is no EVCR issue and there is no COCA issue overall within the financial statements. Now let's come towards the main thing. There are two types of financial statements which are main for the auditor. The number one is statement of financial position and the number two is profit and loss. These are the two types of main financial statements which the auditor has to audit. Now, obviously, we also audit statement of changes in equity. We also audit statement of cash flows. We also audit disclosure notes. All of those things are audited by the auditor. But mainly, even the disclosure notes, the statement of cash flows, the statement of changes in equity, all of those are dependent upon these two main financial statements. If there is any issue within these two financial statements, those issues will also be within statement of cash flows, within changes in equity, within disclosure notes as well. So if these two are correct, then this means that the overall 5 different financial statements are also correct. So the main area that an auditor has to audit are these two areas in the financial statements, in the 5 different types of financial statements. These are the main 2 areas. Now, let's come towards the topic that we were studying: assertion. Management says that our financial statements are correct. Whenever management says that it is correct, they mean 2 things: that there is no EVCR issue within the statement of financial position and there is no COCA issue, COCCA, there is no COCA issue within the statement of profit and loss. What is meant by this? These are the 2 different types of assertions that a management has regarding their financial statements, regarding the statement of financial position and statement of profit and loss. Whenever management says that the financial statements are correct, there will be no issue in them. Obviously, the management will say that. Basically, they mean that there is no EVCR issue within the statement of profit financial position and there is no COCA issue within the statement of profit and loss. Always remember that EVCR is only for financial position. COCA is only for profit and loss. Remember this. Now let's move forward. Whenever management says that there is no EVCR issue in the statement of financial position, this is an acronym. E stands for existence. V stands for valuation. C stands for completeness. And R stands for rights and obligations. So now it is much more clearer to you that whenever the management is saying that our financial statements are correct, there are no issues, you will always first look at the statement of financial position, and basically the management is trying to tell you, the auditor, that there is no existence issue within the statement of financial position, there is no valuation issue, there is no completeness issue, there is no rights and obligation issue. Now let's talk about each one of them. What is meant by each one of them? Whenever a management tells the auditor that there is no existence issue, this means that all the things that we have recorded within the statement of financial position, they actually exist. We haven't recorded anything that does not exist. All the things that have been recorded by us do exist. We have not recorded something extra. So all the things which we have recorded exist. They exist, that is why we have recorded them. Basically, the management is trying to tell the auditor that we have not recorded anything, just we wanted to record it. No, we have recorded everything because it actually exists in the real world as well. We have basically, we have not overstated or over recorded something. Whatever we have recorded, it actually exists. That is why we have recorded them. All the assets, all the liabilities, the receivable, the inventory, the property, plant and equipment, intangible asset. We have not recorded anything because it does not exist. We have recorded because it actually exists and we actually have them. That is why we have recorded them. Number two, valuation. Whatever, now the management in the case of valuation is trying to tell the auditor, whatever we have recorded within the statement of financial position, the value is correctly recorded. We have not made any kind of issues in the value of those items. Example, if the management is recording, let's say, property, plant and equipment at $2,000 within statement of financial position, this means that they are trying to tell the auditor that the value $2,000 is also correct. We have not misstated the value of our items within statement of financial position. The value is appropriate. So this is valuation. The next one, completeness. Let's write down about valuation as well. Every value recorded in statement of financial position is correct. The third one, completeness. Completeness. Whenever the management is trying to tell the auditor that the things recorded within the financial position are complete, this means that the management is trying to tell the auditor that we have not missed any single thing out. Whatever we had to record, we have recorded it. We have not missed any single thing out within the statement of financial position. We have recorded every single thing. Basically, an understatement issue. So the management is saying we have not under recorded anything. We have recorded every single thing. We have not missed any single thing out. So this is any single thing. So this is completeness. Let's come towards rights and obligation. Whenever the management tells the auditor that the rights and obligations is correct or we have the rights, this means that the management is trying to tell the auditors that whatever we have recorded, we have the right to record it. We own that asset. We practically control that asset. That is why we have recorded it. Example, why is leases recorded within statement of financial position? Even though, let's say, you take out a car on lease. Under IFRS 16, which you have studied within F7, which you will study within SBR as well, why is leases right of use asset still recorded within statement of financial position? Why? Although you do not own that asset, but still it is recorded as a non-current asset. Why? Because you control that asset. The definition of the asset within your conceptual framework is any kind of long-term asset which will provide you a benefit for more than 12 months, which you control. It does not use the word which you own. It says which you control is known as an asset. So anything that you are recording within your financial position, you own it, you control it. That is why you are recording it. You haven't recorded anything within statement of financial position because you don't control it, you don't own it, even though you have it at your facility. And if someone else controls that asset, someone else owns that asset, you have it physically existing within your facility, within your buildings, still you cannot record it. But if a management is recording any kind of asset, any kind of liability, this means they have the right to record it. They haven't recorded it because they wanted it to record. They haven't recorded it because they had that asset within their building. The assertion is that management is saying that yes, we control that asset, we own that asset. That is why we have recorded it as well. We control and own. That is the case here. Now, further things that we have to understand within EVCR as well is, first of all, you guys need to understand one thing. Existence. Existence is linked with what? Existence itself is linked with what? This is linked with understatement. Basically, whenever the management is saying that we have not recorded anything because we haven't recorded anything which we do not have, we have whatever we have recorded, it actually exists. This means that management is saying we have not understated anything. We haven't understated any single thing. And what is management? Sorry, we haven't overstated anything. Apologies, I have written it wrong. Management is saying that we haven't overstated anything, not understatement, overstated anything. Because existence means that whatever we have recorded, we actually have it. We have not over recorded any kind of thing. Existence is linked with overstatement. When we talk about the assertion existence, and if you try to link it with the risk within the financial statements, the existence risk is linked with the overstatement, which basically means that if an auditor is trying to verify whether that asset is understated, whether that asset specifically is overstated, that means that the auditor is also trying to verify whether it actually exists or not. If management has recorded something that does not exist, if management has recorded a $1,500 value within their property, plant and equipment, actually it should have been 1,000, because 500 that has been extra recorded has been overstated by the management, because they are saying we also have this car that does not actually exist. Out of thin air, they recorded $500 within their statement of financial position. This means that existence is linked with overstatement. Now, keep this in your mind. Existence is linked with overstatement. Valuation is linked with overall misstatement. Value can be written incorrectly by management. Either it can be over recorded or under recorded. If calculations are done appropriately, we would never know whether something is over recorded or under recorded. But valuation is a combination of both understatement and overstatement. All right. Coming towards completeness. If management is saying that we have not missed any single thing out, basically management is saying we have not under recorded something. This means that management is saying we have not understated something. So completeness is linked with understatement. Completeness is linked with understatement. When we come towards rights and obligations, this is also linked with misstatement. Majorly, we have to understand what it is linked with to understand the basic concept. If we talk about assets now, let's say all the assets within statement of financial position. There are multiple types of asset: property, plant and equipment, intangible assets, investment property, long-term investment in any type of company. Or now let's come towards current assets: inventory, receivable, cash, all those types of assets. I'm talking about all the types of assets within statement of financial position. What is management most likely going to do with these assets? Would they want to overstate these assets or understate these assets? Obviously, whenever the word asset comes to our mind, the more assets that are recorded within your accounts, the better financial image it will show to the users of the financial statements. So there is always an overstatement risk of asset, not an understatement. In 99% of the cases, the risk linked with asset is overstatement. The risk that is linked with asset is overstatement. Because of this reason, which of the following assertions can be directly linked with assets? Yes, existence. Because the management is most probable to record assets which do not actually exist. So, existence is highly linked with assets. Let's not come towards valuation or rights and obligations at the moment, but let's talk about liabilities. We will discuss about those two as well, but let's first talk about liabilities. Whenever the word liability comes to my mind, liability is something that we will have to pay in the future. Management has to pay in the future. What do you think management is most likely going to do with the liabilities? Would they want to over-record the liabilities or under-record the liabilities? Obviously, they would want to under-record the liabilities, because less liabilities represent a better financial image. Again, they represent a better financial image to the users of the financial statements. This shows that a company is a good company. So less liabilities means that management is most likely to under-record them. Under-record them. And which of the following assertions is highly linked with liabilities, can be directly linked with liabilities? Completeness. Because whenever the management is saying that we have completely recorded every single thing, this means that basically management is saying we have not missed any single thing out. We have deliberately, intentionally, or unintentionally did not miss any single thing out. We have recorded everything that we had to record. Completeness, which means this is linked with understatement. Because if an auditor thinks that no, there might be an issue within the completeness, this means that the auditor is saying management may have under recorded, understated some of the things. And what is management most likely wanting to understate within statement of financial position? Yes, the liability. So completeness is linked with liabilities. Now let's talk about valuation. An asset's value can be recorded incorrectly by the management as well. It can be either over recorded or under recorded. That is the case. So valuation is something that is common in both assets and liabilities. Value can be recorded incorrectly in both of these cases. Most probably, again, management would want to over record a value, overstate the value of the asset and understate the value of the liabilities. Let's say management has not missed every single thing out. The completeness assertion is perfectly fine. Management has completely recorded everything, but they might have under recorded the value of the liabilities, which would again present a better financial image of the company. And the same is the case with the assets as well. Management might not have over recorded the assets. They have actually recorded the assets that only exist. This means existence assertion is perfectly fine. The auditor is saying that there is no issue with existence, but they might want to over record the assets that they have recorded. They might want to overstate the value of the assets that they have recorded, which means that the management most likely would want to, in the case of assets, they would want to overstate the valuation, and in the case of liabilities, they would want to understate the value of those liabilities. Rights and obligations are perfectly common within both of these two, because again they are linked with misstatement. When we talk about rights and obligation, they are linked with misstatement. They cannot be linked with directly either understatement or overstatement, but rights and obligations are common between both two. Management has the right to record an asset, only then they should record it. Management has an obligation, they should record it. In essence, both of existence and rights are highly linked with each other, and obligations and completeness, these two assertions are linked with each other. But still, for your AA syllabus and for your practical life, rights and obligations is a separate thing. Now, from now onwards, whenever you hear the word from the mouth of the management within your practical life as well, whenever you hear the words that the financial position which we have prepared is correct, there is no issue in it, it always means that the management is saying that the EVCR of the statement of financial position is appropriate. E stands for existence, which means that every single asset that we have recorded actually exists. We have not over recorded these assets. For V, valuation, from now onwards, you will keep this in your mind that whenever management is saying that valuation is correct, this means that the value is appropriately recorded. What should have been recorded is recorded by us. We have not over recorded the value or under recorded the value for assets or liabilities respectively. Whenever the management tells you that the assertion completeness is also fine, this means that they haven't missed any single thing out. They have completely recorded every single thing which should have been recorded. And most probably management is saying that the liabilities are completely recorded. We have not under recorded anything. And R stands for rights and obligations. Now, these are the assertions that you need to remember for your statement of financial position. From now onwards, whenever you hear the word that the statement of financial position is correct, there is no issue within statement of financial position, it will always mean that the management is saying that the EVCR of statement of financial position is correct. Let's come towards COCA, profit and loss. Whenever you hear the words from the management from now onwards that the statement of profit and loss is prepared correctly, there is no issue within statement of profit and loss. Management is trying to tell you that the COCA of statement of profit and loss is appropriate. Now, what is meant by COCA? Let's move towards that. What is meant by COCA? The first C stands for completeness. The O stands for occurrence. The C stands for, give me a second. This C stands for cutoff. The second C stands for classification. And the A stands for accuracy. So these are the 5 assertions which the management always has for statement of profit and loss. Now let's come towards these assertions. What is meant by every single one? Completeness again means that we have not missed any single thing out. Whatever should have been recorded is recorded by us. We have not missed any single thing out. So this means that we have missed anything. Occurrence stands for whatever we have recorded actually happened during the year. Why? Now listen to this very carefully. You might get confused that occurrence and existence, occurrence of statement of profit and loss and existence of statement of financial position, both basically mean the same thing. Existence means that whatever we have recorded actually exists. But whatever we have recorded within statement of profit and loss, we do not use the word existence for it, not the assertion existence. The exertion here is occurrence. Why? Occurrence means that it occurred during the year. Existence means that it exists at the date at which we are recording at. Why? Because statement of financial position is made at a date as at 31st December 2024. At that date, what are the assets we have? At that date, what are the liabilities we have? At that specific date, not for the whole year. If you had an asset, let's say the year end is 31st of December, the year end of your company is 31st of December 2024. You sold an asset during the year at June 2024. During this year, 6 months before the year end, you sold an asset. You will never see that asset being recorded within statement of financial position, because statement of financial position is made for as at date. At this date, what are the assets that we have? At this date, what are the liabilities that we have? At that date, what are the things, what are the liabilities and the assets that we have? This is how statement of financial position is made. Example, if you have a receivable at the year end, at this date, that is recorded as a receivable. If at 29th of December or 30th of December, one of the customers paid, you had a receivable at that date of, let's say, $30,000 from me, from Mr. Gohar, and Gohar paid that amount to the company would not record it as a receivable. Statement of financial position is prepared as at. That is why the existence word is used, that whatever is recorded actually exists at that date. But when we talk about statement of profit and loss, it is prepared. What is the basic wording of statement of profit and loss? Statement of profit and loss for the year end. It is recorded, it is made for the whole year. So whatever sale you made on 1st January 2024, whatever sale you made on, let's say, 3rd of August 2024, up till the date 31st of December 2024, whatever sales or expenses that happened during the year are recorded. All of them are recorded within statement of profit and loss for the whole 12 months. This is how statement of profit and loss is made. So the word occurred in this case is used, not existence. Occurred means it occurred during the period for which you are recording the statement of profit and loss for which period you are making the statement of profit and loss for. So it occurred during that specific period. This is the difference between occurrence and existence. Now you understand that. Let's move forward. Now, whenever the management says that whatever we have recorded actually occurred during the year, this means that the management is saying we have not over recorded something. We have only recorded the things that occurred during the year within statement of profit and loss. We have not over recorded things that we wanted to record. We have not recorded some things that did not actually happen during the year. We have only recorded the things that occurred during the period. So we only recorded the things. Let me clean it up first. We only recorded the things which occurred during the year. So we have not over recorded anything. Whatever we have recorded actually occurred during the year. This was completeness, and we have also understood occurrence. The next assertion within statement of profit and loss is cutoff. What is meant by cutoff? Cutoff basically means that, first of all, before understanding cutoff, understand this thing that the year end of the company is 31st of December 2024, right? This is the year. This is the date at which We have to make the financial statements. Your year will be cutted off at this date. Anything that happens after this date, let's say on 1st January 2025, anything that happens on 1st January 2025 should be recorded within the next year's statement of profit and loss. Example, a customer contacted you that he wants to buy things from you on 31st of December, but you actually sold him those things on this date. When should the revenue be recorded? IFRS 15 says that revenue is recorded when a performance obligation is satisfied. The performance obligation was satisfied on this date. Even though the customer contacted you on this date, but the performance obligation was satisfied on this date. You sold those things to the customer on this date. So that specific sale revenue will be recorded within the next year financial statements. This date is a cutoff. On this date, no extra revenue can be recorded. Anything that happens after this date has to be recorded in the next year financial statements. Now, there can be a lot of cutoff issues within your practical life as well, within your KIT exam questions as well, which we will look on once we move towards substantive procedures. You will see there as well that management may have recorded revenue that happened in the next year, let's say on 1st of January or 2nd of January, because as I've said previously as well, the process of preparing the financial statements takes approximately 10 to 20 days. So the year end is this date. The financial statement for this date will be completed by the management on 20th of January 2025. So 20 days after the year end, the financial statements will be given to the auditors, and then the auditor will start auditing these financial statements, and the audit will be completed after 3 months. All right. Now the thing is that you have to understand that management may mistakenly or deliberately as well include some of the revenue or expenses that fall within the next year. Because they are preparing the financial statements within the next year, they may consider that, okay, the revenue made on 1st of January, we will record it within the revenues within the financial statements for this year. So they make that mistake. The cutoff assertion means that the management is basically telling you, no, we haven't made any kind of cutoff issues. This means that the management is saying whatever happened during the year, we have only recorded that. Things that happened in the next year, after the year end date, we did not record them in the current financial statement. So cut-off issue is properly done. So there is no cut-off issue within the statement of profit and loss. Next year, revenues and expenses are not recorded in current year. So cut-off assertion means that the management is basically assuming and telling the auditor that there is no issue or no such circumstances where we might have recorded the next year's revenue or expenses in the current year's statement of profit and loss. Classification. Now, what is meant by the word classification? And we have heard this word when we were understanding audit risk as well. I told you that classification basically means that in which specific head this should be recorded. Example of classification is that, for example, something that you should have recorded within administration expenses. Example, how is statement of profit and loss made, by the way? How is statement of profit and loss made? So, for example, normally statement of profit and loss is like revenue, XX, cost of sales, minus it, then we have gross profit, this is the total, then we have admin expenses, AE, this is minus from the gross profit, then we have distribution expenses, this is also minus, then we have interest expense, this is also minus, then we have tax expense, this is also minus, and finally we get net profit, NP, or also known as profit after tax or profit for the year. This is XX. Now, classification means that some of the things, for example, which should have been recorded, if you remember that within our lectures as well, we did one of the audit risk questions where we created a risk that management may have recorded some of the cost of sales things, the expenses that should have been recorded within cost of sales. We think that the management has recorded them within these expenses, because of which the cost of sales has reduced and the gross profit margin has increased. Classification basically means that things that should have been recorded within cost of sales have been recorded here. Things that should have been recorded within administration expenses have been correctly recorded only in administration expenses. Things that should have been recorded within distribution expenses have only been recorded within distribution expenses. Like, classification basically means that the management is telling you, we have not recorded things that should have been within cost of sales. We have not recorded them in administration expenses. Where they were required to be recorded, we have only recorded them there. We have not missed out from there and recorded them in another place. Although the management isn't missing something out, but according to the IS 1, or now known as IFRS 18, and the management has to prepare the financial statement as such, they do not mix up the expenses. Every single type of expense is separately recorded. What comes within cost of sales, by the way? What is recorded within cost of sales? Any expense that is directly related to the inventory that you are selling, inventory against which revenue is being recorded, and the same inventory which you are selling, any expenses in relation to them are only recorded within cost of sales. That is a small definition of cost of sales, although within SPR you study a very detailed definition for cost of sales. But for now, just understand this as a concept. Any direct expenses related to inventory should be recorded within cost of sales. What if management has recorded some of these direct expenses of inventory within distribution expenses? This means that the classification of this expense has been done incorrectly. This is classification. This is the assertion of classification. Classification means where things should have been recorded, we have only recorded them there, or in those heads. We have not mixed the expenses or mixed the incomes. We have not recorded revenue as other income. We have not recorded other income as revenue. All right. So basically, management is saying that the classification of our expenses, every single thing within statement of profit and loss, is done appropriately. Coming towards the next one, accuracy. Accuracy is again linked with valuation. Valuation meant that the value that is recorded for a particular type of thing within statement of financial position is appropriate. The value is not over recorded or under recorded because of, let's say, an issue, an error, or fraud. Whatever the case is, the value is appropriately recorded. But in the case of statement of profit and loss, the meaning is same, only the word is different. Accuracy means that the values that have been recorded in every single head within statement of profit and loss, those are recorded correctly. We have not recorded inappropriate values in front of the revenue, in front of cost of sales, in front of administration expenses. We have recorded the correct values. So accuracy stands for values are correctly recorded. Accuracy stands for values are correctly recorded. So from now onwards, whenever you hear the sentence from the management that the financial statements which we have prepared are correct, this word correct will always mean in your life from now on that management is saying basically that statement of financial position has no EVCR issue and the statement of profit and loss has no COCA issue. Further on, every single word has its own meaning which you need to remember for your exam and your practical life as well. For the statement of financial position, management always has the assertion that there is no EVCR issue, no existence issue, no valuation issue, no completeness issue, no rights and obligation issue. And for statement of profit and loss, management has an assertion that there is no completeness issue, no occurrence issue, no cutoff issue, no classification issue, and at the same time, no accuracy issue as well. So basically, from now onwards, whenever you hear the words assertion, the things that always must come to your mind are EVCR and COCA. Basically, management is saying there is no EVCR issue within statement of financial position and there is no COCA issue within statement of profit and loss. Although some of these can be linked with the other one as well. For example, the classification, although it is not included here, still for non-current liabilities, we can say that, let's say for loan, the classification might have been done inappropriately by the management. That is also an issue that can be created within your exam questions as well, which we we will learn as we move towards the exam question. But for now, you just need to understand them. Now, coming towards the main thing, which we have to understand. Completeness. We have not missed every single thing out. This means management is saying we have not under recorded anything. It is linked with understatement. Understatement. Occurrence. We have only recorded the things that actually happened during the year. This means that we have not recorded something extra or over recorded something. This means this is linked with overstatement. Management is saying we have not overstated anything. This is linked with overstatement. Cut off. Cut off basically means that whatever happened in the next year has been recorded within the next year. It has not been recorded within the current year. Only the things that happened up till the year end date, only those have been recorded. We have not recorded anything extra from the next year. So this cannot be linked with understatement or overstatement. This is linked with misstatement. Because expenses can also be recorded in the current year of the next year, or revenue can also be recorded of the next year within the current year. Classification is not linked with understatement or overstatement. Places might have been shifted for the expenses or incomes that are recorded within profit and loss. This means misstatement as well. And accuracy, value is appropriately recorded. Again, value can either be over recorded or under recorded. It can be both, either understatement or overstatement. So this cannot be linked with either one. This is overall linked with misstatement. Now, coming back towards our exercise. What are the main things within the statement of profit and loss? The first thing is revenue. What would management like to do with revenue? Whether they would like to overstate it, would they like to overstate it or understate it? If you are a company, you are making your financial statements, obviously you would want to show a healthy financial image, and a healthy financial image can only be shown by more revenue within statement of profit and loss. So management are by default would want to overstate the revenue. So revenue is majorly the risk that exists within revenue is overstatement risk. And what can be linked here with overstatement? Completeness, no, it is linked with understatement. Occurrence, no, it is linked with occurrence, yes, because it is linked with overstatement directly. Occurrence means whatever we have recorded actually occurred during the year. We have not missed any single thing out. So management would most likely want to say that revenue is only recorded which has occurred during the year. We have not over recorded the revenue. So now in 99% of the cases, occurrence is linked with revenue. Occurrence is linked with revenue. But when we come towards expenses within statement of profit and loss, the more expenses there are recorded, the lower the profit after tax would be. And profit after tax is a very important figure for the users of the financial statement. So if you lower your expenses, if you under record the expenses, the profit of the company would increase. So management is most likely to understate the expenses. There is always a risk of understatement within the expenses. And which of the following assertions here can be linked with understatement? Completeness. Why completeness? Because when management says that we have not missed any single thing out, we have recorded every single thing that occurred during the year, we have not missed it at all. This means that the management is saying we have not under recorded anything. We have recorded every single thing that happened during the year. And what would they like to majorly under record, understate? Expenses. So completeness is majorly linked with understatement. Understatement and expenses. So completeness is one of the main assertions for expenses. Revenue is occurrence is one of the main assertions for revenue, and completeness is one of the main assertions for expenses. Just like that, as for assets, one of the main assertions that management has is existence, and for liabilities, one of the main assertions that they have is completeness. By default, you need to understand these words, like these are the assertions. What are the assertions that can be directly linked with asset, liabilities, expenses, incomes? What are the assertions that can be directly linked with it? Because if you don't understand which assertions can be linked with which of the things within financial statements, then it is very difficult for you to create substantive procedures and to understand the next things that we are about to do. So these are the assertions that you need to remember for your exam. It can be tested as a separate topic as well, but majorly it will be tested within substantive procedures as well. How it will be tested within substantive procedures, we will discuss it later on. You don't need to understand that at the moment, but just understand one of the few things that you need to understand, one of the first things that you need to understand within substantive procedure is assertion itself. Whenever management asserts that the financial statements are correct, they are basically asserting that there are no EVCR issues within statement of financial position and there are no COCA issues within statement of profit and loss. Furthermore, you need to understand every single assertion regarding statement of financial position and every single assertion of statement of profit and loss, and which assertion can be linked with which specific item within statement of financial position and profit and loss. You need to also understand that. Now let's move forwards towards the next thing. Now, you guys need to understand one of the main thing is that assertion is just one thing within substantive procedure. Although it is a one separate topic or one separate, you can say a syllabus area within your audit, but assertion is just one thing that we need to understand. There are other multiple things as well that we need to understand for substantive procedures, and in itself, those other areas are also one-on-one other or a separate syllabus area within the audit. But let's move towards the next thing. The next thing that we need to understand, so this one was assertion. Let me give the heading first of all for you guys as well, that this was assertion. And the second thing we need to understand is evidence. So whenever we say evidence, what does it mean? As an auditor, for example, the evidence when we were identifying whether the screen within my phone is changed or not, there were multiple procedures that we did, and we had to obtain an evidence whether it is, whether yes it is replaced, whether no it is not replaced. So the place where I was obtaining that information from is known as the area of evidence, the area which I will be testing, which is also known as the area which I will be testing, and also known as basically evidence area. Example, in my phone, the settings app was the evidence area. That is from where I was going to get my evidence from, whether the screen is replaced or not. The same is the case with the audit of financial statements as well. You need to identify what are the areas that when you will be auditing the financial statements, from which specific things will you identify the evidence or get the evidence from. Where will you get the evidence whether property, plant and equipment that is recorded by management, is it correct or not correct? If it is not correct, you need to have an evidence that these are the evidences from which an auditor found out that the property, plant and equipment is incorrect. If you are stating that yes, the property, plant and equipment is correctly recorded, you are providing a reasonable assurance over it. This also means that you must have an evidence which shows that it is appropriately recorded. Now, in the field of audit, there are multiple areas from where you can get evidence from, but mainly you only need to remember this thing. And what is the thing? Again, the acronym is DADA 3. This is the acronym for the word evidences, or where you will be able to find out the different types of evidences. From DADA 3, you will be able to find out the evidences for the financial statements. Now, what is DADA 3? Let's understand that. The first D stands for documents. The A stands for assets. The D stands for directors. The A stands for accounting records. And the final 3 stands for third party. These are the main areas where you will be able to find out the audit evidence against the heads within financial statements. Let's say if you are trying to verify the intangible assets, whether intangible assets are correctly recorded or not, then obviously you will need to find your evidences from any of these areas. Either you will have to look through the documents, either you would have to look at the assets themselves, either the directors, either the accounting records, or third party. Now, what is meant by every single one? Let's discuss that. Document means physical evidences. Document means physical documents which you can check, which you can ask the management to give them to you and you can check them. Example, invoices. Let's say for revenue, if you are trying to verify whether this was actually sold by you or not, then you can ask the management to give you give you invoices against the revenue, you can check those invoices. And if against, let's say, cost of sales as well, or purchases or other expenses, those are expenses which have been recorded by the management. If you want to verify those expenses are correctly recorded or not, then you can also check out what? Check out the invoices against those expenses. You can tell the management, give me the invoices, I would like to check them. So whether now further on, you can break it down yourself. Invoices like income invoices, expenses invoices, but invoices in general. The second one can be good delivery notes, GDNs, good delivery notes, or also known as delivery challans, delivery notes. Or better yet, just remember them by good delivery notes. Whenever, let's say, the customer company says that I have recorded $1 million of revenue, this means they have sold something worth millions of dollars. They have sold things worth millions of dollars. This basically means that they have multiple invoices against this $1 million, and the customer must have acknowledged this, that yes, I have received the goods. That is why the company is recording, the company that I'm auditing at the moment, they are recording a revenue of $1 million. Their customers to whom they sold these products to, they must have acknowledged somehow that yes, we have received these products from this company. And how do they acknowledge that? They basically acknowledge it through GDNs, through good delivery notes. What happens is that within your practical life as well, if you, let's say, in the future have a company, once, let's say, my customer has bought this microphone set from me. My customer has bought this microphone set from me. Now, when I'll send this microphone set to my customer, I'll have to record revenue. But before recording revenue, two things will be sent to the customer as well. One, an invoice will be sent to the customer. And secondly, I'll send the customer a GDN as well, good delivery note. This would mean it will be written on a piece of paper that this is the product worth $100, has been sold to you at this date, and you have received this product. Please sign it here if you have received it. If the customer signs it, the customer has to send back this GDN to the company who sold it, means me. The company will have to send this back to me, and I'll save it as a document for the audit. When the auditor comes to audit my company and asks me, I want to verify whether $1 million of revenue that you have recorded, first of all, can you even show me that did you actually sell these things, or you just recorded them out of thin air because you wanted to show an increase in your revenue? So to make sure that the auditor has some sort of an evidence, the company will show them the GDN, the good delivery note. The company will tell the auditor, see, this is the piece of paper upon which this customer has also signed. See this piece of paper, the customer has also signed here that yes, I have received the product. This will be an evidence for the auditor as well. So GDN is another type of evidence area for the auditors. The next type of document is agreement. The agreement that is made between company and other parties whenever they are doing something. Example, if you are taking out a loan from the bank, you have to sign an agreement with the bank. Upon that agreement, it will be written how much amount of loan you are taking, when will you repay back the loan, what is the interest rate upon the loan. All of these things impact how loans are calculated. So when an auditor is going to audit something, he can check out that agreement with the bank as well that the company has made with the bank. Upon that agreement, it will be written what will be the interest, what will be the loan amount that is the company taking, when the loan has to be repaid to the bank. So it will be helpful for the auditor to understand, is the loan being calculated appropriately or not. So agreement, there are different types of agreement, not just loan agreement. If the company is constructing, let's say, a building for their customer, first of all, there will always be an agreement. Every single detail will be written within that agreement. The auditor can always check out that agreement for multiple different verifications as well. If, let's say, I am leasing out a building, I am recording a right of use asset. One of the major evidences in that case again is an agreement that has been made by the company who has leased me out that specific building, because it is important for an auditor to identify, if you are recording a right of use asset, do you actually have an asset that has been leased out by you, or just recording it out of thin air. So these agreement is also an area where an auditor can find out evidence. Again, the next one is contract with employees. Let's suppose if a loan has been taken by the company's employee, the company themselves will record it as an asset that this loan will have to be repaid back to us after 2 or 3 years. Loan receivable, basically receivable, will be recorded by the company. The company can record, if they want to overstate the receivable, the assets, they can record loans receivable from employees so much of it, and the auditor would not be able to verify it. First of all, the auditor can check out the contract, whether the employee who took out a loan has signed it, what is the interest rate upon the loan, how it will be calculated as well within financial statements. So all of these things, these documents, the auditor can check them, and again, using these documents, the auditor can verify many things. Now, when we move towards actual questions of substantive procedures, we will go in detail upon what sort of documents have to be selected for every single thing. But these are the major types of documents that we will be taking the name of. Document is first of the things where an auditor can get evidence from. The next one is the asset itself. Physically checking the assets can provide a lot of evidences to the auditor. Physically checking any type of asset, for example, the management has said that the asset has been recorded at a correct value. How can you verify that? You can physically check the asset. Let's say, what if the asset is damaged? How will you verify what is the amount of damage that should be recorded? What is the how big of a damage has the asset had because of a storm or any kind of natural occurrence? How will the auditor know whether the asset actually exists or not? Management may have over recorded something. So evidence can be obtained from physically checking out that asset as well, which is in the audit field known as count, an asset count or an inventory count. So physically checking the asset can also provide a lot of evidences to the auditor. How do we use them within substantive procedures? We will discuss it later on, not right now. Just understand the different types of evidences. Directors themselves. If you remember, in one of the previous lectures as well, we were discussing that these directors, the non-executive directors, the executive directors of a company, they all have a meeting together every single day, every single month, every single quarter, every single year. The non-executive directors and the executive directors have meetings with each other, and during these meetings, whatever is discussed is written down by someone who is present at that meeting. That person is known as the company secretary, and whatever is written down, this piece of paper, this document is known as minutes of meeting. So whatever is discussed within these meetings is known as minutes of meetings. This is known as minutes of meetings, that every single thing that was discussed during these meetings have been written down. Now imagine if there is a provision that must be recorded by the management. If the company is in any kind of litigations or legal notices with another company, a provision has to be recorded. Don't you think that such informations will be discussed during the meetings of the non-executive directors? If the non-executive directors believes that our revenue is going out and we might not be able to do businesses within the next year, these going concern situations, don't you think that they will be discussed within the board meetings as well? All of these things will be written down within the minutes of the meetings. Auditor can get a lot of the evidences from these minutes as well. By reading these minutes, maybe the auditor will be able to identify other things that haven't been recorded within the financial statements. For example, the company has recorded no provision, no liability against a supplier, and the auditor is not able to find out. The auditor is basically assuming, okay, payables are properly recorded, there is no issue in it. In the board minutes, it has been discussed and written down that there is a supplier with whom the company is in dispute with, and the company will not record a payable against it, because the company is in dispute with this supplier. Now the auditing sense will just come about. The professional skepticism will just arise. Why? The auditor will say, why is the company not recording a payable against this? The auditor will first of all check up the breakup of the payables. Has the company recorded any kind of payable against this supplier? No. He will go on and discuss with the management. Show us the amounts which you haven't recorded against this supplier. This is how minutes of the meeting can also help the auditor to identify any additional misstatements within the financial statements as well. The evidences, auditor can gain evidences from these areas. So in the case of directors, the proper word is minutes of meeting. Minutes of meetings. This is another area from where the auditor can gain a lot of the evidences. Accounting records. When we talk about accounting records, if anything is written upon the face of the financial statements, the heads, the financial line items, revenue, in totality, it is always written there. There is always a breakup available. Within these, of these revenues. And further to the breakup, all the transactions are recorded. If you guys haven't taken the previous lecture, let me give you an example of what we have been discussing within one of the previous lecture. I'll just touch it out. I will not go in detail because it is a very big topic. I told you that if revenue, let's say, is recorded at $1 million, the auditor cannot audit every single thing out. The auditor has to do every single thing on a sample basis. This is something that you know. But how does the management record revenue? There are multiple transactions that are recorded against revenue. For, let's say, there are multiple different transactions, thousands of different invoices. The total breakup that make up the $1 million revenue would be 10,000 different invoices of sales. Adding all of those invoices make up a revenue of $1 million. But the case is that for every single transaction, every single invoice, one invoice upon which the sale is written as $100 of revenue, how would the management record it as revenue within statement of profit and loss? One transaction would be recorded, right? Debit receivable if the cash isn't received yet, or debit cash if the cash has been received, $100, and the credit would be done upon revenue, $100. This is known as one single transaction. The auditor will ask the management, give me the list of total transactions which make up the revenue. Give me the list of the total transactions that make up this revenue. So there will be 10,000 different transactions written down on an Excel sheet, and the Excel sheet will be shared with the auditors. The auditor will select a sample from this sheet and then give those samples to the management, and then the management will give the invoices against this sample to the auditors, the invoices, the GDNs, whatever the auditor asks. This is how auditor audits the financial statements, right? Accounting records are these breakups. These breakups, these GLs, every single credit entry into revenue would be recorded on a GL, would have been recorded within a GL, and that GL would be basically a T account, either on the credit side or either on a debit side, like this, and the total will be $1 million. So this is how revenue is recorded. The auditor will ask the management to share them this GL. From this GL, the auditor will select the sample as well. The thing is that you need to understand, you always need to ask for the breakup, which are basically accounting records. You always need to ask from them, from the management, because what if there are some of the things that are suspiciously recorded within these GLs? The auditor will only be able to identify them if he has specific GLs for every single item. So let's come back. Within accounting records, these GLs itself are areas from where the auditor can identify evidences. Secondly, reconciliations. What are reconciliations basically? What is a reconciliation? If you remember, within FA1 or within F7 as well, you heard the word reconciliation. Let's say, assume an example that I would like to give you is regarding, let's take an example of trade receivable, right? Trade receivable. Company says they have a receivable of, from customer A, they have a receivable of $1,000. And when, as an auditor, we asked that customer, we discussed with that customer, how much do you have to actually pay this company? This company has recorded a receivable of $1,000. How much do you have to actually pay this company? The customer tells the auditor that I only have to pay $100. I don't know where this extra $100 is coming from. I only have to pay this company $900. I don't actually understand why has the company recorded additional $100. This difference has to be identified by the management. Like, why is this the difference? Maybe the management is right, or maybe the customer is right. Auditor cannot trust anyone. This difference, when it is investigated, why is this difference arising? That is known as a recon. When you are investigating a difference, like why is this difference occurring, that investigation itself is known as a reconciliation. And during that reconciliation, remember that specific reconciliation is prepared by the management. The auditor doesn't prepare it. But within that reconciliation, it will be on a piece of paper. The company would have written, okay, we have written down that we have to receive $1,000, and the customer is saying they have to pay $900. There is a difference of $100. The company will then show, okay, this is the invoice number because of which $50 difference is arising, and this is an invoice number because of which $50 difference is arising. The auditor can check out the reconciliation to identify why these differences are occurring. What are the basic reasons behind these differences in balances that are occurring? So this is known as reconciliation. The auditor can identify many different things from these reconciliations as well. Reconciliation is also a type, also a place where the auditor can obtain evidences from. All right, remember that. The final type of area where the auditor can gain evidence from is known as third party. The auditor can gain evidences from outside the company, third parties, outside the company. Always remember that a third party evidence is much more reliable than an internally generated evidence. Example, if the management is giving you an invoice versus the customer himself is giving you an invoice, you will always rely upon the customer himself. You will never rely upon the invoice that has been given to you by the management. Now, this is just something that you need to remember. This is the generic information. But third party, within third party as well, there are separate areas from where the evidences can be obtained. Number one is confirmation. Confirmation from receivable. The discussion that we had with our customer A, that the company has recorded $1,000 of receivable from you, whereas how much do you have to pay? This is a confirmation that we are taking from the customer of the company that we are auditing. We can take a confirmation from the payable as well, from the supplier as well. We can take a confirmation from the bank as well. Example, let me give you an example. Confirmation means that basically the auditor makes a piece of paper. Upon that piece of paper, the heading is confirmation, and the auditor writes down, we are auditing XYZ company, and this company has recorded a payable of or a receivable, whatever the auditor wants to write down. Like if you are sending a receivable confirmation, the word that will be used here will be receivable. If you are sending out a payable confirmation, the word will be different. So if the auditor is saying we are trying to verify receivable, the auditor will write down, we, as the company has recorded a receivable of $1,000 from you. If this amount is correct, please sign here and write down your name as well, to whomever who is confirming this confirmation. If this amount is wrong, please sign here and write down the correct amount as well. Like what do you actually have to pay? If you agree with the management, then sign here and also write down your name. If you don't agree with the management, then sign here and write down the actual amount that you have to pay. This piece of paper will be sent to the address of the customer of the company that we are auditing. The company we are auditing at the moment, their customer will receive this confirmation from the auditor. They will sign and give us the right amount. If it is wrong or if it is right, they will sign here and send this confirmation, send this confirmation back to the auditor directly. This is known as a confirmation. You can send a confirmation to the bank of the company. You can send a confirmation to the receivables of the company, to the customers of the company. You can send a confirmation to the suppliers of the company. Against suppliers, the company has recorded payables. Against customers, the company has recorded receivables. In the bank's case, in the case of banks, they would have recorded bank balances. Because within statement of financial position, we always have within current assets, the number third thing is cash and bank balances. The breakup of this is that company is saying within, let's say, American Express, we have this much amount sitting within our accounts. Within Discover Bank, we have this much amount sitting in our account. So the auditor will prepare a confirmation and send to this bank. Ask this bank, do they actually have this amount sitting in their accounts? Do they actually have this cash with you in your account? The bank will say yes. Hey, the Discover Bank will say yes. These are the separate banks that are within America, by the way. So this is known as a bank confirmation letter. A customer confirmation letter would be a receivable confirmation letter. A supplier confirmation letter would be a payable confirmation letter. All right. So this is a confirmation procedure that an auditor can do against the balances which have been recorded by the management within financial statements, and the auditor can send out confirmations to whichever customers they want to send, to whichever suppliers, to whichever banks they want to send. But the second place within third party is correspondence. What is meant by the word correspondence? Always remember that within the world of business, in the world of businesses, every single thing that is discussed between different companies is always done on emails, on text messages, on letters, physical letters that are sent to other companies. It is never done on phone calls. It is never done orally. In short, nothing is discussed by tongue. Every single thing that is agreed, that is discussed in written format, which in itself is an evidence that, look here, this was discussed between two companies. Auditor can check out these discussions to identify anything that he wants to identify. Example, you know that the company we are auditing, they have a customer against whom they have to receive $1 million. That customer is not going to pay the company. How can you identify whether they are going to pay the company or not? Either you can send a confirmation, the customer would confirm, or the second thing which you can do is that you can check the correspondence. Check out the discussion that has happened between the company we are auditing and their customer. Check out what are they discussing. In that discussion, has the customer ever mentioned that I won't pay you anything? Because if that is mentioned, then a bad debt should be recorded against this customer by the company. If within statement of financial position, receivable shouldn't be recorded, a bad debt expense should be recorded. To verify the balances again, these evidence areas will be used. And in the case of correspondence, the auditor can check the correspondence between different parties in the company. Let's say the lawyer and the company, a case has been made against the company, a provision should be recorded or not. Let's check out the correspondence. The company has broken a law. Let's check out the correspondence between the company and the government and the regulatory authority. Let's check out whether the regulatory authority has told in this correspondence to the company that you will be fined this much amount of money. That amount should be recorded as what? As a provision, as a liability. Company has to pay it. Whether the liability is recorded appropriately or not, this is where you get the evidence from. So correspondence is also another area from where the auditor can obtain a lot of evidences from. Correspondence is another area from where the auditor can obtain a lot of evidences from. Now, these are the 5 areas from where within your practical life as well as your examination life, in both of these lives, you will obtain your evidences from data 3. You have to remember that for the exam as well. So please ensure that you remember it. Now let's move towards the next area. Now, coming towards the third piece of puzzle, which completes the area of substantive procedures, is procedure itself. The name of the third area is procedures itself. Actions. Procedures means the actions which an auditor can take to verify something. Action to verify something. So what does an auditor has to verify? The auditor has to basically verify the balances within the statement of profit and loss, the balances within the statement of financial position. The actions that he takes to verify these balances are known as procedures. Now the question is, what are the actions that he can take? What are the procedures he can perform to verify these balances? Let's discuss them. Again, there is a mnemonic for them, and the mnemonic in this case is vowels. What were the English vowels when you studied them when you were a little kid or a little child? The vowels were A, E, I, O, U. And these are the procedures which an auditor can do, the actions which an auditor can do to verify the balances. Now, let's discuss them one by one. A, E, I, O, U. A stands for analytical procedures. Analytical procedures. E stands for inquiry. I stands for inspection. O stands for observation. U stands for, now a U is a bit odd because it is recalculation and reperformance. The case is that why you, there is nothing starting with you in the terms of procedures or actions. The auditor can either recalculate or reperform R basically. So A, E, I, O, R was not the appropriate one. So instead, in order to remember it, vowels, U, starts with R basically. So what is the procedures? If we talk about them in detail right now, what is meant by the word procedures? When we talk about analytical procedures which we have already covered up within risk, which we have already covered up within audit risk, when we were performing analytical procedures upon the substantive, upon the financial statements given to us by the management of the company, we discussed that. Calculations and comparisons which are done by the auditor, and if an auditor identifies any kind of unplausible relationships within the financial statements, then the auditor discusses them with the management. This is analytical procedure. Example, if let's say loan balance, the non-current liability of the loan is increasing as compared to the previous year. In the previous year, the company had a loan liability of $2 million. In the current year, the loan liability is $4 million. Why would the loan liability increase? It would only increase if the management has taken more loan during the year. That is why the liability has increased, right? Now, what is something that in the statement of profit and loss that is linked with this loan liability? The interest expense. If the interest expense is decreasing, whereas on the other hand, the loan liability is increasing, this means that management may have understated the loan. So the action that he can take is, first of all, perform this analytical procedure, identify this relationship. Now there are many things that are related within the financial statements. Depreciation is linked with property, plant and equipment. Amortization is linked with amortization is linked with intangible asset. Distribution expenses are linked with revenue. So if the revenue as compared to the previous year is increasing, the distribution expenses should also increase. The same is the case with cost of sales. If revenue is increasing, cost of sales should also increase. Gross profit margins should almost remain the same. If in the previous year the gross profit margin was 30%, in the current year it is 100%, this, or let's say 70%, it means that the cost of sales has decreased. It has not increased as much as the revenue should have increased, because cost of sales is directly linked with revenue. If there is an increase in revenue as compared to previous year of 50%, cost of sales should also increase by 50%. Distribution expense is linked with revenue. There are multiple things that are interconnected, interlinked with each other, which we have discussed in detail within audit risk section. I have explained every single relationship that there can be within the financial statement, and we have discussed that in great detail. You should remember it up till now. But the thing is that performing these analytical procedures in itself is an action that an auditor can take. And then once an unplausible relationship is identified, once an unrelated relationship is identified within these analytical procedures, the auditor can discuss these with the management and discuss with management that why is there such a difference here. There, in that case, in this procedure, the auditor will be able to identify if there is a misstatement within financial statement. So analytical procedure in itself is a procedure as well. Number two, inquiry. Inquiry from whom? What is meant by the word inquiry? Inquiry means asking something from someone. Inquiry can be a confirmation, the thing that we just discussed within data 3 as well, the evidence side as well. Asking confirmations is again inquiry. So this is a procedure that an auditor can make, that send out a confirmation to the receivable balances to confirm the amount of the receivables, send out a confirmation for payable balances to confirm the amount of payables. The second one is discussion with management itself, discussion with the management. Discussing some things with the management itself is what? Itself is a type of inquiry. So here in the case of analytical procedures, comparison and discussions. This is one type of procedure. Confirmation and discussion with management is another type of procedure. Another thing, inquiry can be also in the form of a written representation. And now written representation is also something that we have discussed up till now. A written representation is something that we have discussed up till now in many different circumstances. In the case of audit procedures, in the case of audit risk, in the case of evidences which we discussed. Written representation is something that when, let's say, you are unable to identify other evidence areas for, let's say, property, plant and equipment, you write on a piece of paper that property, plant and equipment is properly recorded, there is no error made within property, plant and equipment, and you tell the management that you have to sign this piece of paper. This is known as a written representation. In the future, this reduces the liability of the auditor. How? Because if in future someone comes to the auditor and says, see, you said that property, plant and equipment are correctly recorded, whereas I know that there is a fraud done within property, plant and equipment. You were not able to identify that fraud. The auditor can simply pull out that written representation he has, which management has signed, on which it is written and property, plant and equipment is properly recorded. Management has signed it. This means management has taken the responsibility for property, plant and equipment. Although this is a thing, this is a procedure which is least responsible. Why? Because if you remember, within this lecture I also said that internally generated evidence is least reliable. Evidence that you receive from the management is least reliable. Written representation is a form of evidence that you receive from the management. It is one of the least reliable evidences. It is only done as a last resort. If you are doing other procedures as well, then you can also, at last, you can also take written representation. It is an additional procedure that you can perform, but you must perform other procedures to verify the balances as well. Now, this was the second one, inquiry. The third one is inspection. Within the field of audit, whenever you have to check something out, you never use the word check, you always say inspect. For example, if you are checking an invoice of revenue, if you tell the management, give me invoices of revenue, I would like to check whether the revenue recorded by you is correct or not. I would like to check them through invoices and through good delivery notes, whether they have been signed by the management. Everywhere you use the word check, you never use it, you inspect. You always use the word inspect. So this means checking something. Never use the word check within your audit procedures. Within the field of audit, always use the word inspect. The next one, observation. O stands for observation. Observation basically means that you stand at a corner in a room and you observe something. You just see how management is recording something, how management is doing something. Observation is a procedure that is not much reliable. Again, why? Because observation, you don't have an evidence. An auditor never has an evidence whether he observed something or not. The work of an auditor is also reviewed by regulatory authorities. Example, in the UK, whatever company is audited by auditor, that is reviewed whether the auditor performed correct audit or not. That is reviewed by FRC, Financial Reporting Council. Every single listed company within United Kingdom, UK, their audit is reviewed by FRC. So FRC reviews that and grades whether the audit was done appropriately or not. 1, 2, 3, 4, 5 grades. From 5, 1 means good, 2 means bad, 3 means very bad, 4 means really bad, 5 means you are done. Your audit firm is going to close. We will put such a huge penalty upon you that you will have to close down your audit firm. You will not be able to pay that penalty. So observation, when you stand in a corner of room, let's say management is recording, then management has said that we record revenue as soon as we receive an invoice. You want to verify whether it is done actually or not. You want to perform a procedure. You can stand in a corner in that same room where the management is sitting, and you can just sit there quietly and observe the moment invoice is received, whether management records it or not. Now, this is not a reliable procedure. Why? Because auditor also needs to have an evidence whether he did something or not. If you are just standing at a corner in a room and you are just observing the things, you can't show an evidence to FRC. You will never be able to show an evidence to FRC whether you actually observed something or not. Observation is a procedure that is majorly done for internal controls. When you are testing the internal controls, observation is done there. Observation is not done in the terms of procedure. Although it is a procedure, we never use it within substantive procedures when we are verifying the balances within financial statements. So check. Observation is something that you only see. Saying something is observation. Whether management is actually doing it or not, this is observation. Final one, recalculation and reperformance. Students always have confusions. What is the difference between recalculation and reperformance? Recalculation means something you just recalculate. When you just recalculate something, it is known as recalculation. Example, depreciation is calculated by the management at, let's say, 20 years of life. You simply take the carrying value of that asset divided by 20 and recalculate that depreciation. You did not use your own assumption. What are the judgmental areas here? The life of 20 years is a judgmental area. Whether life is correct or not, you did not verify that. You simply did the calculation which management does it as well. You simply took the carrying value of the asset, divided that by 20 and calculated the depreciation charge and checked whether the same depreciation is recorded by the management or not. This is known as recalculation. You are not raising a question upon the fundamentals, the judgmental areas which are included within that calculation. Example, life was what? A judgmental area. What is a judgmental area, by the way? If you don't remember what a judgmental area is, I have explained this many times within the previous lecture as well, but still let me explain it for the newer students. Judgmental area is where a standard does not guide you what you have to do. Example, IS 16 is linked with what? The property, plant and equipment. IS 16 simply states that the life of an asset should represent its economic life, which basically means that for how many years you will use that asset, that should be taken as the life of the asset. Nowhere the standard says that for laptops 5 years is the life, for machinery 10 years is the life, for a plane that you have bought 20 years is the life. The standard does not exactly tell you what life you should use. Just like these, in other standards as well, there are multiple areas where judgment has to be used to identify what value should be used in this case. Life is a judgmental area. It is an estimate, a management's estimate that this is the life that we will use. Now, in that case, when you raise a question upon judgmental areas as well and then recalculate, that is known as reperformance. Recalculate, no question. Recalculate means, in simple words, no questions raised on judgmental areas and simple recalculation done. Simple recalculation done. That is known as a recalculation procedure. Reperformance means questions raised on judgmental areas and then recalculation done is reperformance. So you basically recalculate, but this time you also check out whether the life that is used by the management is that even correct or not. First, you check that out as well. That is known as reperformance. So example, a procedure would be, first of all, try to identify whether the life that is being used by the management, is it even correct or not. Example, you can ask the management, where did you pick up this life? The auditor can also compare the life of that asset with the industry average. Industry average means that, for example, the company has a machine for which it is using 20 years of life. Let's see another competitor or another company which is using the same type of machine, what life they are using at the moment. So life should be similar for similar types of asset. If the life is right, then this means the management is using the correct life of the asset. And then you can recalculate based upon that life. Let's see what the depreciation expense is then. Then you verify whether the depreciation that is being recorded by the management, is it correct or not correct. So these are the procedures which an auditor can do to verify whether something recorded by the management, is it correct or not. Now let's come towards the next thing, which is very important. How do you create substantive procedures? Now let's move back towards the main topic. All of these things, the assertions, the evidence areas, and the third one, which one was procedures. All of these things are always combined whenever you want to make a procedure. Let me come back towards the first thing that we studied. The first procedure that we made for the for verifying whether my phone screen is original or not, whether it has been changed or not. I told you every single procedure has a goal. Goal means what do you want to verify. Every single procedure has an action that an auditor has to take, and every single procedure has an area, mentions where you will get the evidence from. So this means that whenever, now let's come towards substantive procedures, how you will make the substantive procedures. Now, if you understand this correctly, if you have understood every single thing that we have done up till now, and if you understand these things that I'm about to tell you properly, believe me or not, making substantive procedures is going to become very, very easy for you. Like, substantive procedures will be the easiest thing that you will do within your exam. If you understand this properly, always remember the three things. First of all, every procedure must have three things. Must have what? Number one, a goal. Number two, an action. Number three, where the evidence will be gathered from, the area of evidence. These are non-professional words which are used to make you understand how a procedure is made. Now let's use professional words. Now let's move towards professional wording. What would be the professional wording in each case? Every single procedure that you make will always contain a goal, which means which assertion you are trying to verify. Which assertion you are trying to verify. First of all, okay, I'll come to that later on. Action. Which procedure the auditor is doing? From AEIOU. Assertion, either EVCR or COCA. Procedure means AEIOU, which procedure the auditor is doing and where the evidence is being gathered from. Which area the evidence is being gained by the auditor. So data 3. Whenever you want to make a procedure or whenever you want to make a substantive procedure, when you have to verify a balance of the financial statement, this is how you will always make a procedure. You don't need to learn the procedures, by the way. Many of the students make this mistake. They learn the procedures and then they try to write down the same procedures with an exam. Although this is a good approach. I wouldn't say that this is not a good approach. This is a good approach if you are unable to understand the technical areas within audit. And if you don't want to be an auditor within your practical life as well, then you can simply learn the procedures and write it down within the exam. Surely the substantive procedure area is something that you will just pass. If the question is for 10 marks, you can gain easily 5 marks. But if you want to gain the full 10 marks, this is the approach that you will use. You don't need to learn the procedures. You need to learn how to create the procedures on your own. How do you think of ways to create the procedures? You need to learn that technique. The technique is very simple. The technique is very simple. Apply AEIOU on data 3 to verify EVCR or COCA. So first of all, your goal will be to understand the auditor has asked to verify which specific item. Is it receivable? Is it property, plant and equipment? Is it a liability? Is it an asset? Is it income? Or is it expense? Because we know that for statement of profit and loss and statement of financial position, the assertions are different. So for example, the examiner has asked you to verify an asset. Asset falls within statement of financial position. What are the assertions for statement of financial position? EVCR. So automatically you will know I have to verify either existence, valuation, completeness, rights and obligations to a specific item that the examiner has asked me to verify. I don't need to even think of COCA. Now you will understand that I have to apply these procedures, either analytical procedure, inquiry, either inspection, O stood for observation. We will not do observation, by the way. In the case of substantive procedure, forget about observation. I've just written it down in AEIOU so that you can remember. Or I will apply recalculation, reperformance U on data 3. These are the areas from where I will always get my evidence from. Either the documents, assets, director's minutes of the meeting, accounting records, reconciliation, GLs, or third-party evidences. I'll apply AEIOU on data 3 and I'll have to mention which assertion am I verifying at the moment. Let's do an example now. Let's do an example and try to make some procedures on our own using this technique. So this is an so this is an example scenario which I've introduced for you guys, which I've copied and pasted from your Kaplan kit for you guys, and we are going to make different procedures for it. The question that the examiner has, he's saying, make procedures to verify balances of receivables. So a company has recorded some receivables. We need to verify whether the amount recorded by the management is correct or not. Please remember that you do not need to have any kind of value. What is the value recorded by the management? Even if the examiner doesn't given it within the question, it doesn't matter at all. Because we will always produce our procedures using the technique we have, the technique we have just learned. We will, although within the exam, in the next lecture, I will also let you know how procedures are made when you start reading the scenario. But within this lecture specifically, we will ignore what is written within the scenario. We only know that the examiner has stated that he will give us 6 marks and we have to verify the balances within receivable. Now, whenever you find out a question that we have to verify this amount, this specific items within the financial statements, always first understand how is that specific thing recorded. Always first understand how is receivables recorded. So any sales that are made by the company and the customer is not paying for it will pay later on after 30 days or 60 days, whatever the policy of the company is, that specific amount is recorded as a receivable if the customer has not paid with it. So the double entry for it is debit receivable for, let's say, XX amount, and credit is always revenue. XX amount. Now, this is the first thing that impacts the receivable. The second thing that always understand what impacts this. Always you need to have at the back of your mind what impacts these figures within the financial statements. The receivable is impacted by what? You need to understand every single area where receivable is what impacts the receivable. So the first thing is sale itself hits the receivable. Second thing, what is the second thing that hits the receivable or impacts the receivable? If you receive any kind of cash from a customer who had purchased upon credit, you would have recorded receivable against it. If when you receive the cash, you would have to de-recognize that receivable because you have received that specific amount. So receiving the cash from the customer also impacts the receivable. The double entry for that would be when a customer pays you, you would debit the cash and you would credit the receivable. This is the second impact upon receivable. What is the third impact upon receivable? Bad debts. If a customer hasn't been paying for a long time, it's been, let's say, normally you tell the customers that you have to pay within 30 days, but it's been, let's say, 40 days or 50 days since customer A has not paid you. If the customer is taking a lot of time to pay you, this means that they may not be able to pay you back, which is a risk that we created within the risk questions. But here you have to record a bad debt if the customer is taking longer than your normal credit period. This means that this would also impact receivables because now you will record a bad debt expense within profit and loss and you will have to again de-recognize the receivable. What is the double entry in that case? The double entry is you would have to record an expense of bad debt, double X, and you will have to credit that receivable, de-recognize that receivable. Now, this is the third impact upon a receivable. These are the three areas by which a receivable can be impacted. Always remember, whenever you're about to create substantive procedures, you need to have at the back of your mind, you always need to understand what are the things that always impact this area which I'm about to verify. Substantive procedure essentially means that you're about to do something by which you will be able to verify whether that amount recorded within the financial statement, is it correct or not correct. So this doesn't mean that you will actually gain evidence that whether this amount is correct or not. You're basically guiding your audit team members. Think of it as a way that you are an audit manager or an audit senior manager. You will send junior team to audit the company and you're now telling them what procedures you will perform to verify this amount. You are basically telling them, keep that thing in your mind, and always keep in your mind what are the things that impact this specific area. Now, if I have to verify the receivable balances, I don't need to know what the receivable is recorded within the statement of financial position, whether it is 1,000, 2,000, what are the different customers. I don't need to do that. I'll just guide my team. These are the things that you will do to verify this amount. So the first of all, let's come back towards our technique. The technique was very simple. Okay, by the way, I missed out on one thing. 6 marks for procedure. Every single substantive procedure that you write down will give you 1 marks for it. This means in this case, we have to write down 6 different substantive procedures to verify receivables. This means that we have to write down 6 different substantive procedures that verify the receivable balance from different angles, from different areas where we will gain evidences and verify the same receivable balance. Let's come towards the technique now. The technique was apply AEIOU on data 3 to verify EVCR or COCA. Receivable is an asset. It is recorded within statement of financial position. This means that the management is basically saying or assuming or asserting that EVCR of receivable is correct. E means existence, valuation, completeness, and rights and receivables. When we were discussing assertions, I always told you when we talk about assets, management would most probably want to overstate those assets. This means the risk is of overstatement. Overstatement is linked with 2 or 3 different assertions. What were those? Existence, whether the receivable actually exists or management has recorded extra receivables just to show a better financial image. So existence is one of the assertions that we will need to verify. Valuation is something that value might not be incorrectly recorded. Mostly management would want to overstate the value of receivables so that they can get a better financial image of the statement of financial position. So this is an assertion we will have to verify. Finally, rights. Do they actually have the rights? Have they actually sold something to this customer against which this receivable has been recorded? So this is how we will create the procedures. And just to have an example, in exam you won't do this approach, but just to have a better understanding, let's assume management has recorded a total receivable of $2 million within their statement of financial position. Just as an example, I'll use this amount to continue so that it is easier for you to understand the procedures we are going to make. So first of all, let's talk about existence. Let's talk about existence itself. How can we verify whether an amount recorded by the management, does it actually exist or no? Does it actually exist or no? How can we verify if management has recorded some amount, do they actually have a right to record it or not? Okay, let's discuss it. Always remember, first of all, that every single thing that an auditor does, he does it on a sample basis. Always remember it. He does it on a sample basis. Auditor never tests every single thing out. So this means that all of this $2 million of receivables, we will not verify that. We will verify some of this amount on a sample basis. This means, first of all, we need a breakup of receivables. This means, first of all, we need a breakup of receivables. And breakup how? Breakup in the number of customer. Like customer A owes how much, customer B owes how much, customer C owes how much. All of these customers combined owes $2 million, which is recorded by the management. So first of all, we need a breakup of balance customer wise. We need a breakup of balance customer wise. Now this is again the next thing that we will keep in our mind, that always know that auditor does every single thing on a sample basis. He requires a breakup, first of all. And from that breakup, the auditor will select a sample. And what type of a breakup will be required? Either a breakup of invoice will be required, invoice-wise breakup will be required. All of those invoices combined make up the amount that is recorded, or a customer-wise breakup will be required. So let's come back towards our technique. So first of all, let's assume we have to verify the existence, whether the receivables that have been recorded by the management, do they actually exist or not. Let's come towards procedure. Let's come towards the technique. Technique said that apply AEIOU on data 3 to verify the assertion. Here we are trying to verify the existence. To verify existence, what is the procedure that we perform and from where can we get the evidence? So coming back to our procedure, can we perform an analytical procedure here, like compare it with the previous year, compare the receivables of the current year with the previous year and try to identify whether there is a significant difference as compared to the previous year? Yes or no? Okay, we will come towards that later on, not right now. Let's move forward. E, inquiry. Can we inquire from the management or can we send out a confirmation to the receivables? Yes. This confirmation was sent to receivables, payables and banks. These are the three main individuals or companies to whom confirmations can be sent to. So we can send a confirmation to the customers of this company that we are auditing to verify whether the balance recorded by the management does it actually exist or no. So this would basically mean that if the customers agree that yes, I owe this much balance to this company, this would basically mean that yes, this receivable actually exists because the customer confirms it. Now, how will I make a procedure? First of all, I'll have to select a sample again from a number of different customer A, customer B, customer C. I told you, we cannot audit every single thing. And this has to be mentioned within the substantive procedure. The examiner expects you to write down a professional substantive procedure, not a substantive procedure where you simply say, send out a confirmation to the receivable balances. No. This would be the incorrect way. Every single thing that you will do within your practical life has to be mentioned within the substantive procedure as well. Within your practical life, you know, I can't test every single thing out. I have to select a sample. For selecting a sample, first I need that breakup. And the breakup will be customer wise balance breakup that I will ask from the management. From that breakup, I'll select a sample of different customers to whom I will send the confirmations, and then this will help me verify the existence of the receivable balances. Let's come back towards the clean notes and write down the first procedure that we just made. So first of all, the first procedure which I am making is, first of all, I'll ask for the breakup. Obtain the customer wise breakup from management for the receivables and select a sample of what you have to mention it, sample of different customers, customer A, customer B, customer C. Maybe you select there are 100 of different customers, you select only 10 to which you will have to send the confirmations. You don't have to mention how many you will have to select, but you have to mention what sample you are picking. Select a sample of customers. Select a sample of customers. Once this has been done, I'll prepare that confirmation and send them this confirmation. And I've told you within this lecture as well what a confirmation is. Confirmation is that we write on a piece of paper that this company that we are auditing told us that this is the money, this is the amount of money that you owe to this company. Is it true or no? Sign it. I don't need to mention this in detail. The word confirmation itself means that the auditor will do this. The examiner does not want you to explain the word confirmation. Simply writing down confirmation means that the auditor is doing this. And send a confirmation to the selected customers to do what? To do what? Coming back towards the notes, I told you a good procedure, a procedure for which you will get 1 marks, must contain these three things: assertion, procedure, and evidence. In our procedure that we are making, we have already mentioned the procedure. We are making the procedure of inquiry, a confirmation. Evidence will be again from the three confirmation itself. So evidence has been mentioned, where you will gain the evidence from whether the balance recorded is correct or not. The third party evidence is the procedure that we have. Evidence is the thing that we have mentioned within our procedure. We have also mentioned the procedure that we were performing. Now we need to mention the assertion. What are we verifying in this case? We are verifying the existence of receivables. To verify existence, to verify existence. Now let's stop here. Let's move back and try to create the number two procedure. Let's try to create the number two procedure. Because in total, we have to create how many? We have to create 6 different procedures. For every single procedure, we will get 1 marks. Now, a lot of you students have already gained this idea that, sir, now I understand substantive procedures. I can do one more thing. If I go back to the assertions that are used by the management, I also selected that I have to verify the valuation. How can we verify the valuation of receivables? Again, we can send out a confirmation to the same customers, select a sample, send them a confirmation. And upon that, because we will have mentioned that this is the amount you owe to this company, if the customer signs it, this will also verify the valuation of the receivable as well. But this is the place you are wrong. Let me write down the second procedure first of all. Let me write down the second procedure. Again, we will obtain the customer wise breakup from management for the receivables and select a sample of customers and send a confirmation to the selected customers to verify what? Valuation. Now, a lot of you might think that this procedure is also correct because in this case, we are sending out a confirmation to the selected sample to verify the valuation. In the above case, we send out the confirmation to verify existence. Do you think the customers that are present for the company, are they so much free? They are not doing their normal courses of business that they would respond to you 2 times? Nah. Do you think the companies, the audit client, your audit client is going to let you send 2 different types of confirmations, one to verify existence, one to verify valuation? Nah. Because if you send too many confirmations to the same customers or even to other customers as well, this means you are upsetting the customers of the company you are auditing. Maybe because of you send out so much information to them, you took so much of their time, the customers of this company will say, we are not going to do business with this company anymore because the auditors of this company disturb us a lot. Same type of procedure cannot be performed to verify different assertions. Please keep this within your mind. The examiner states that wherever I find out that my student has performed the same type of procedure to verify 2 different types of assertions, and if that student thinks that he will get the marks for the other procedure as well, for the other assertion procedure that he has created as well, I'll not give him the marks. Rather, what he should do is that this same procedure can help verify existence and valuation at the same time. So he should just add a comma and include valuation as well. Now read it. Obtain the customer-wise breakup from management. Obtain the breakup first of all. For the receivables, then out of that breakup, we will select a sample. We will select a sample of customers. To those customers, we will send a confirmation. Upon that confirmation, the balance will be written. Once those customers confirm the balance, automatically the existence, whether those customers actually exist, receivables actually exist, that will also be verified. And when they sign, the valuation will also be verified. So if the same procedure is verifying 2 or 3 different types of assertions, you cannot break it down into 2 procedures and simply add at the end the other assertion. Nah, you will not get the marks for it. So this is not allowed within the exam at all. But what you can do is that create the same one and write down the assertions. It doesn't mean that you will get 2 marks now or 1.5 marks now. You will still get 1 marks for it. You will still get 1 marks for this specific procedure that you have written down. You will never get 2 marks for it. But it will be a more professional looking procedure that you would have written down, because now the examiner will know that this student specifically knows that every single procedure verifies what different types of assertion. The same procedure also verifies what? Rights as well. Because if a customer is signing a confirmation, this means that you have actually sold things to that customers. So you have the right to record the receivables as well. So with the same procedure, you can also verify what? The rights as well. The rights as well and rights. So from the same procedure, I'm verifying 3 different assertions, but I'll get 1 marks for it. And I cannot break down the same procedure into 3 different procedures and at the end of each procedure mention the assertion that I'm verifying. Nah, I can't do that. If you assume that you will get 3 marks for it, no, you will only get 1 marks. And stop wasting your time within the exam as well. The time is very important. Writing down the same procedure again and again is not going to give you scores. Now, a lot of students now have this in their minds of, we have already verified existence. With this procedure, we have verified the existence, we have verified the valuation, we have verified the rights. Is there a need to perform more procedures? Yes. As an auditor, you have to verify the balances from different angles. Let's make other procedures now to verify the same assertions. We can make different procedures to verify the same assertions. Now let's try to make the same, now let's try to verify existence and valuation again, but this time let's make a separate procedure. Let's make a different procedure. Coming back towards my technique, I have to apply AEIOU on data 3 to verify what EVCR or COCA. Let's forget about COCA at the moment. Let's forget about EVCR at the moment. I know I have to verify existence, valuation, and rights. I know this in my mind now. I have remembered that. But let's come towards procedure. What other procedures can I perform? What can I gain evidences? You can look at it at three different, like from three different angles. Either you can start with the procedure, identify this, is this the procedure, can I perform, is this the procedure, is this the procedure, okay, I can perform inspection of what, let's move towards evidences. Or you can start making a procedure from the evidence itself. First, we made a procedure by starting from the assertion level. Now, let's try to make a procedure by starting from the evidence level. Let's try to identify. The first type of evidence we can obtain is from the documents, invoices, GDNs, agreements, contracts. Now, a lot of you might say, sir, if we are selling anything to the customer, we will have an agreement against that customer. Let's inspect that. Let's check out that agreement. Management must have that agreement. To verify what? How will you verify the balances of receivables from those agreements? There is no way you can do that. Always make a procedure that makes sense. If you are making a procedure that does not make a sense, that will not get you marks within the exam. You have to make a procedure by thinking practically how you will do it within the practical life as well. If you think practically, if you ask for an agreement or a contract that the company has with the customer, and out of that contract, you try to verify whether the balance recorded by the management is correct or not, can you do that? Obviously, no. In the agreement, nowhere it will be mentioned, this is the receivable that I owe you. Contract means that simply some of the terms and conditions will be agreed between the company and their customer. And according to those terms, company will have to provide the service. That's it. So by agreements, we cannot verify the receivables. There may be other things we can verify, but no, not from this. Let's try to make a procedure by using invoices as an evidence. Can we use invoices to verify whether the company has recorded correct receivables or not? Can we use invoices to verify whether customer-wise balances have been recorded correctly or not? Let's think of it. Let's think of it. Let's think of it. Every single customer, the receivable total balance has a breakup, customer-wise breakup. Customer A owes 1,000, customer E owes 3,000. Okay, let's take customer A for an example. We are just trying to make a procedure. Customer A owes 1,000. How can we verify that he owes 1,000 by using invoices? Can we ask the management that if $1,000 of receivable against customer A has been recorded, do you have a further invoice-wise breakup of this $1,000? Like, what did you sell this customer that makes up a total receivable of $1,000? On that invoices or the GDNs, the customer would have also signed that I have received these things. So this means that this is another angle by which I can verify whether customer A owes this company $1,000. So I can now, once I have made this procedure, I can now select a sample of different customers, and for every single customer, I can request the management give me the invoice-wise breakup, and then test out those invoices. Then test out those specific invoices, whether those things have been actually sold or not. A nice procedure. And this would verify what? This would verify what? Both existence and valuation at the same time. The sum of those invoices will make up $1,000 receivable from customer A. So this means that the value can also be verified from this procedure, and the existence. Do they actually owe you something or no? Got it? So coming back towards the clean notes, let's make a procedure for it. Obtain, first of all, again, I need to have the breakup. Obtain the customer wise breakup from the management for the receivables, and select a sample of customers and request the management to provide the invoices of sales that make up the selected receivables to verify the valuation and existence of receivables, whether we have sold something or not. Another procedure we can make now, the sort of evidence that we will be looking for will only be changed. Example, instead of invoices, we can also ask the management to give us good delivery notes. That now the procedure might be the same, but where we will be obtaining the evidence from, that is going to change. That is also a correct procedure. First, we ask the management to give us the invoices. Now we will be asking the management to give us the good delivery notes. On the invoices, we will be able to verify whether these things were sold, and from the GDNs, we will be able to verify whether these things were received from the customer, whether he has acknowledged that yes, I have purchased these goods from the company for this amount. So the procedure can be the same now. Again, this procedure can just be copied and pasted into the third number procedure. Apologies. We can copy this, we can paste it here, and simply within this procedure, we can change the word provide the invoices. No, provide the good delivery notes of sales, then make up the selected receivable. And doing this, we would be able to verify again the existence and the valuation. A separate angle verifying the same assertion. No matter how many times you can verify the same assertion, the examiner has not capped that. But the examiner has said same type of evidence, same type of procedure cannot be done to verify another type of assertion. All right. So in first case, that was the issue. In the second case, we are changing the area where we will be obtaining the evidence from. In the second case, again, we are obtaining a breakup. Again, we are selecting a sample of customers. Again, we are demanding the company to give us an evidence. And that evidence this time is to provide us with the GDNs that make up the total of these receivables. So three different procedures have been made by us up till now. Now let's try to make three more procedures. But this time, instead of going to the documents, let's try to do something else. Let's try to do something else. Now, first procedure was the one which we made when we started with the assertion. The next procedure was the one which we made when we were starting with the evidence section. Now let's move towards the procedure section. From procedure, let's move backwards and try to create a procedure. Okay, can we perform any analytical procedure? Can we identify, is there some sort of a calculation which we can perform? And if that calculation is inappropriate, shows that there might be misstated receivables, we can discuss that with manager. What is the type of calculation we can perform in this case? Oh yes, we can perform a calculation which is known as receivable collection days. How much days it is taking for your customers to pay you back. How is it calculated? Receivables divided by sales multiplied by 365. That is how it is calculated. So you don't need to mention that specific formula, but you can mention the auditor can calculate the receivable collection days for this year and the previous year. If there is a significant increase within receivable collection days, then we can discuss with management that this increase is not justifiable and allowance might be required to be recorded against this. This procedure would help us verify what? Not the existence. Existence needs some kind of an evidence, some kind of a document. No. A confirmation or a document. Valuation can be verified in this case, that the value recorded within the statement of financial position, is this correct or not? Because maybe the management has not recorded a bad debt against it, an allowance against it, which would impact the value of that specific receivable. Again, as I told you, three things impacted always. The receivable is impacted by three different things. We have made a procedure upon this area, receivable revenue, sales invoices. We have made a procedure upon cash. We haven't made any kind of procedure upon cash, by the way. We will make that as well. But right now, we are making a procedure upon trying to link it with the bad debt. So the fourth type of procedure which we are about to make is what? This was the third one. The fourth type of procedure which we are about to make is the auditors should calculate the receivable payment days, receivable collection days for the current year and the previous year, and if there is an increase in receivable days, then it should be discussed with management. Then it should be discussed with management that an allowance is required for these receivables, to verify, and this will verify what? To verify valuation of receivables. Please remember, we are not trying to verify the value of the bad debts recorded by the management. That was an expense. We are verifying the value of receivables only. Whatever impacts the receivable side. Okay, now bad debt, comparing it with bad debt. Is there another type of procedure which we can create upon the bad debt? Is there another type of thing that can verify the same angle but with a different sort of evidence? The same thing that has to be verified whether bad debt is properly recorded or not, but with a different type of angle, like let's say changing the evidence or changing the procedure but verifying the same assertion, whether bad debt is correctly recorded or not, to verify valuation. Let's think of it. Is there something the auditor can take which helps the auditor to identify every single customer, like how many days it has been since he has not paid his amount? I think there is something within documents that we just discussed. Within documents, this one in Data 3, within documents, there is another thing which is known as, there is something, let me add it here. There is something additional which is known as receivable. What is it known as? Aged receivable listing. Aged receivable listing. This listing is a document upon which it is written, a breakup of the total amount of receivable is given in such a way that customer A, it has been 45 days since he hasn't paid us $1,000, which is receivable at the moment. Customer B from them we have a total receivable of $3,000. It has been 70 days since he hasn't paid us this amount. Customer C, so on and so forth. These days are given, that how many days it has been since they haven't paid us. Every single company in the world has a policy, like at a bare maximum, after how many days the customer should pay us. Example, there is a company within my country as well, for whom the average is like 30 days. The policy of the company is the customers must pay us within 30 days. If the customer exceeds 30 days, that means that an allowance for them should be recorded within the accounts. Okay, this is a difficult thing for you to understand. Let's make it easier for you. Let's ask the management to give us aged receivable listing in which the breakup would be given as such that how many days it has been since every single customer hasn't paid us. And we will try to identify the most oldest customers who haven't paid us. Let's say customer A, it's been 70 days. Then there is a customer Z who hasn't paid us in 600 days. His $10,000 balance has been due for 600 days. It's been 600 days since he haven't paid us. The auditor would identify the most oldest receivables that the company has still recorded within their balances. This breakup, when you ask the management to give you a breakup of $2 million, this means anything that a breakup includes has been recorded by the management. If a management has also recorded that 600 days old receivable, still that has been recorded. It's been 600 days, more than 2 years since that customer hasn't paid you. Why have you still recorded as a receivable? Receivable can only be recorded when it is confirmed that the customer will pay you. Here there is a doubt that the customer won't be able to pay you. It has been 600 days. So that should be recorded as a bad debt, which would affect the value of the total receivables recorded within statement of financial position. See, now another type of document has been selected. Aged receivable listing From that, the auditor would identify the most oldest receivables which haven't paid the company, and then discuss with the management that an allowance has to be recorded against these, a bad debt has to be recorded against these to verify the valuation of trade receivables. So this is another procedure that we can make right now. So this is the fifth one. The procedure was the auditors. First, they have to obtain what? First, they have to obtain the 8 receivable listing, which they will have to request the management for. The auditors should obtain the aged receivable listing. The auditors will obtain the aged receivable listing. What will they do after that? They will have to identify the oldest customers who haven't paid the company and identify from this listing the oldest customers, or a better word for that is, instead of using the oldest customer, use the word this listing, and identify from this listing long outstanding receivables. Long outstanding again means the oldest ones, but this is the more professional wording that you will use within your exams as well. Long outstanding receivables, and from this listing, identify long outstanding receivables and discuss with management the need to record a bad debt against them to verify what? This would help them verify the valuation of the receivables. To verify valuation of receivables. Okay, this is the fifth procedure which we have created. Now let's move towards the sixth one. Let's try to make a sixth one. Always and always remember, whenever we talk about receivables, you will get a lot of questions within your exam kit as well, where the examiner has asked you questions that you have to make procedures for receivable. Whenever that is the case, always remember that there is a procedure that you can make. What is the procedure? Now listen to this very carefully. The year end of the company is, let me make it upon the rough side, this here. The year end of a company is, let's say, 31st of December 2025, or sorry, 2024. Let's make it 2024. The year end of the company is 31st of December 2024. The thing is that I told you that the start of the year would automatically be what? 1st of January 2024. This is the start of the year, 12 months period. And for this 12-month period, the management will have to make the financial statements. These financial statements are not easy to make. Like, it doesn't take 1 or 2 days to make the financial statements. On a basic level, on a bare minimum level, it takes the company almost 10 to 15 days to make these financial statements, or 20 days. For our scenario, let's assume 20 days will take the management to make the financial statements. The financial statements are made after the year end. Once the year has ended, all the transactions have been posted within the GLs, transactions have been recorded, debits and credits have been done, then the financial statements are made. This means almost 20 days will take the management to make these financial statements. This means the financial statements will be ready at, let's say, 20th of January 2025, 20 days after the year. And this is the date when the financial statements will be ready. These financial statements will be handed over to the auditor. The auditor will start the audit at this date. The auditor will start the audit. Once the auditor starts the audit itself is a period of 2.5 to 3 months. Let's assume 3 months will take. It will take 3 months for the auditor to complete this audit, or even 2.5 months. This means the audit will be completed somewhere around 31st of March 2025. 31st of March 2025. This period, when the financial statements have been handed over to you up till the audit is complete, this period is known as subsequent period. This period is also an area from where you can obtain evidences. Example, if a company has recorded a receivable amount of, let's say, customer A owes the company $1,000. Normally, it is 30 or 60 days after which the customer has to pay. This means even after the year end, customer must have paid the company that we are auditing, right? Assume this, like if the company has recorded a receivable at this date, there are 3 months in which the audit would be completed. During this period, the company may have received a payment from customer A or must have received a payment from customer A, customer B, customer C. To from how many customers the payment has to be received? A, B, C, D, E, F, G, H, I, J, K, L, M, N, O, P, up till Z, Z, A, Z2, whatever, if 200 customers are there. But the customers will pay the company within this period as well. The majority of the customers will pay the company in this period. This means the cash will be received by the company in this period. Can the auditor do something to verify whether cash has been received within these 3 months? And if any customer is not paying back within even these 3 months, this means that if he's taking more than even 3 months to pay the company back, this means that he might not be even able to pay you back. So, and a bad debt should be recorded against that. But how will the auditor verify which customer has paid and which customer has not paid? How? Simple. Always remember there is another document. There is another document which the auditor can use. Let me include that here within the list of documents as well. There is another document which the auditor can use. Let me include it here. Sorry, not there. Let me include them within the clean notes as well, because majority of the things I've already included within the clean notes. So let me include it here. There is another document which is known as bank statement. Every single month, even if you have a bank account, obviously majority of you have bank account right now, upon your email, don't you receive your bank statement? Yes, you do. On that bank statement, isn't it written what income did you receive, what cash did you take out, what cash did you receive? So don't you think the company receives their bank statement as well? They do. The auditor can check those bank statements to verify whether these customers have paid the company or not. And those customers who haven't paid even in these 3 months, these should be discussed with the management that, bro, you need to record an allowance, a bad debt against them, because it's been 3 months since they haven't paid you. Why would they pay you even after the audit is complete? So you have to record an allowance against them. But the main type of evidence is coming from these subsequent bank statements after the year end. So basically we need the bank statements for what? The next 3 months: January 2025, February 2025, March 2025. The auditor will check these three different bank statements, the period from here to here, these 3 months. The auditor will check the bank statements for these 3 months and identify whether any kind of payment has been received from these customers or not. See, again, I'm creating procedures, but I'm not creating illogical procedures. These are all logical ways to verify the balances of receivables that have been recorded by management at the year end. Although, if the cash is received after the year end, add here the receivable would still be recorded. This receivable will be written off in the next year financial statement, but somehow it will confirm to me, yes, these customers are paying this company. So this means that the receivable which have been recorded with them by the management do actually exist. Their valuation is also correct, and at the same time they have the right to record it before, because if a customer is paying the company, this means they actually bought something from the company, right? So these after the year end bank statements are known as subsequent bank statements, subsequent period bank statements, subsequent bank statements. So we can check these subsequent bank statements as well to verify whether cash is being paid by these customers or not. Let's make a procedure for it. The sixth procedure is the auditor. First of all, we need these subsequent bank statements, right? The auditor, first of all, has to obtain these subsequent bank statements from the management. The auditor should obtain the subsequent bank statements from management And once one, I need the subsequent bank statement as well, and I also need the customer-wise breakup of receivable balances. Only then I will know which customer owed which much, how much, and what amount have they paid subsequent to the year end. So, from the management, and also obtain the customer-wise balance breakup of year end. And now what action will he take? He will compare, he will verify whether the customers which owed the balance at the year end have paid the company in the subsequent bank statements. Those who have not paid, it has to be discussed with the management that a bad debt has to be recorded against it. And verify whether customers have paid their balances subsequently, and if any customer has not paid, then this should be discussed with management. Apologies, now the spacing is very almost no spacing available for me to write further, but let's write it out somehow. With management, discuss with management. I will write it down upon the next page. Let me make a page here for it. Why not? This should be discussed with management to record a bad debt against customers who have not paid. And this will help me verify what? Verify the valuation of receivables, because if someone is not paying, this means receivable is over recorded. It has to be under recorded. A bad debt has to be recorded at the year end for those customers who are not paying subsequently. If a customer is not paying me even after the year end, 3 months even after the year end, this means at the year end, the balance that has been recorded, it is overstated. The value is not correct because a bad debt has to be recorded. A bad debt has to be recorded against it. This means the valuation at the year end is not appropriate. Would have been customer have not paid, to verify valuation. And at the same time, if a customer is paying me, this means he actually bought something from me. This means I have the right to record those receivables who are paying me the balances. Okay, so this would also help me verify the right to record the remaining receivables who have actually paid. And right to receivables. So guys, these are the 6 different procedures which we have made within this lecture, and by understanding only the technique up till now, we have made these procedures. Please understand that using the technique to make your procedure is just one way of making the procedure. Sometimes there are situations within an exam where you can not only rely upon the technique. There are some procedures which you have to learn. Some are the procedures which are different to make within the exam, like not by using the technique, you still have to make some procedures. Although within this lectures we have understood the basic technique to make the procedure. This is the basic understanding of substantive procedure, the assertion procedures where the evidences are gained from. Always remember, before ending this lecture, I would like to let you know that always remember, a good procedure will always contain 3 things: what procedure is being performed by the auditor, where the evidence is being gathered from, and also which assertion is being verified. So only after these three things have been mentioned within the procedure, the examiner will give you scores for it. Otherwise, the examiner clearly says that scores will not be given for the procedures which do not contain these 3 things. Either there are only 2 options: either you can learn the procedures from your Kaplan book, But the better option is that you should understand the technique to create procedures. How many procedures do you want to create? How many? Doesn't matter if you want to create 10 procedures, 18 procedures, or 20 procedures again against a single line item. It will be easier for you if you understand the technique to create the procedures. So this is it for this lecture. Please remember that within the next lecture we are going to understand other ways how procedures can be created. This is not the end of substantive procedures. We have to understand other ways how procedures are created. We will also move towards other areas of the financial statements which are important for your exams, and we will create at least 5-6 different procedures for each of these areas within the recorded lectures. Within the next lecture we will do that as well. We will understand how what other ways are available for you guys, using which you can create more procedures as well. Not just by using the technique, there are other ways using which you can create the procedures as well. Just like by using using only the technique, we have made 6 different procedures. Imagine if you use all the things that I teach you to create the procedures, you will be easily able to make 15 to 20 different procedures for a single line item that is within the financial statements. And within the next lecture, we will also move towards the major areas which have been tested within your past exam, for which the examiner has always asked to make a procedure for. So we will make procedures for these areas as well. Up till the next lecture, please, if you have any questions, please remember that I'm available on WhatsApp 24/7. You can ask me questions. You can ask me how am I creating these procedures. You can also ask me any other questions that you might have within your mind. I'm always available upon WhatsApp. Up till then, please take care and tata, bye bye.